In this video, I'm talking about which raise portfolio is best. Hi, thanks for joining me. If we haven't met before, my name's Angela. I'm your money messenger. My background is working in financial planning. I've got 20 years experience in that industry, teaching people how to save money better, use money better, repay debt and get wealthier. I'm also an investor myself. Everything I teach you in these videos, I do myself. So in this video, we're talking about which raise portfolio is best. If you've seen some of my other videos, you know that I've been promoting the Raise app for about 4 years now. I think it's a fabulous financial product that's come onto the market to help people get started investing in exchange traded funds, which are essentially shares, to get started investing using little money. So which portfolio do you select? Well, it depends on 3 things: your goals, your time frame, and your risk profile, your risk tolerance. So let's talk about those more. Think about your goal first of all. Why do you want to open up a Raise account? With anything in life, I find, especially planning money, I find it's easier to think of what you want first. What is your goal? What is your ultimate end game? And then work it backwards to know what investments you need, what insurance you need, what debts you need or need to get rid of, for example. It's easier that way if you know where you want to get to work it backwards. So think about why you're doing a Raise account. If it's something short term, like you want to save for a car or a holiday, maybe that's going to be done with a few months up to a year, investing is not the way to go with such a goal that's so short term. Now that your goal then leads into your time frame. If you've got a time frame of 3 or 4 or 5 years, then you definitely should be investing, and you could pick a portfolio which has higher amount of shares, because that means your return potential could be higher, you could make more money, and you've got the time to ride out those share market fluctuations. If your time frame is 7 years, 10 years, nothing really particular, Angela, I just want to make some money for my future, then you can definitely pick one of the portfolios that has the highest allocation to shares, because you want to make the maximum amount of money. You're not worried so much about the short-term fluctuations. With a 10-year goal or a 7-year goal, you don't care what the portfolio is worth in a year or two. It doesn't matter in the scheme of things. And then your third thing to consider is your risk profile, your risk tolerance. And this is super duper important, regardless of what type of investing you do, whether you're buying an investment property, whether you're investing in shares, crypto, whether you're putting your money in term deposits in a bank. Your risk profile is super important because it determines how tolerant you are to risk, how well you sleep at night knowing that your money is invested in shares or riskier investments. We see a lot of people jumping into crypto lately, but I don't think they're realizing that their risk tolerance to invest in crypto, you need a high risk tolerance because it's so volatile. And if you don't have a high risk tolerance, which means when crypto prices drop dramatically, you freak out, you sell your holdings, you just want out because you're scared you might lose more. That means that your risk profile was not matched to the type of investment you picked. So with Raise, you're investing in shares essentially. You need to have a risk profile. Depending on which portfolio you pick, your risk profile needs to be comfortable with the amount of shares you're holding. You need to be comfortable that if the market drops, like it did a year ago, when the pandemic first started, we had a big market drop, a share market drop. And I know some younger investors that had only had their Raise portfolio for maybe a year or so, and they cashed it out because they saw it drop, they freaked out, they got scared they were going to lose more money, and so they cashed it out. What they then missed out on is that when the share market went back up, they missed out on recouping their losses, and actually the share market's gone well past where it was before. So they've missed out on those gains. That is like the worst thing you can do when it comes to investing. So your risk tolerance needs to be in line with the portfolio you pick. So let's quickly go through the different portfolios that Raise has, because they've got 5 major portfolios, and then they've got a couple of extra portfolios that they've stacked on there. So the conservative, I've just checked these figures today, the conservative has about 25% share exposure and 75% cash and bonds. Bonds are fixed interest term deposits, for argument's sake. So that means if you had $1,000 in your Raise portfolio and you picked the conservative with 25% exposure to shares, $250 of your money will go into shares using exchange traded funds, ETFs, which are essentially just a pool of shares that the Raise investment manager is putting together for you. So that's quite a conservative portfolio. If you've only got 25% of your holdings in shares, that's quite conservative. That sort of a portfolio suits people that have a short-term time horizon, time frame. I say minimum 1 year. It's for low risk tolerance people that want to make more than a bank account, but not really particularly comfortable with big share market holdings. So the moderately conservative portfolio has 35% shareholdings and 65% cash and fixed interest. So these returns will be higher than the conservative portfolio because you've got more shares, which have more risk, which has more returns. So it's best suited still with people that aren't too particularly comfortable with shares or quite new at it, or just don't want to have a lot of volatility. They don't want to see their portfolio going up and down, the value of it. So you will experience more volatility, ups and downs in the short term compared to the conservative portfolio, but your returns will also be a little bit higher. And I think this portfolio is best for people that have got a 1 or 2 year time frame. But even that, really got to stick to 1 or 2 years. That is still quite short in the scheme of investing. Now, the moderate portfolio, this is close to 50-50, 50% shares, 50% cash and term deposits, bonds. This one's probably your base portfolio. I don't think you should be using a Raise account if you've only got an investment time frame of 1 or 2 years. So I probably would just really ignore the conservative and the moderately conservative portfolios, quite frankly. I think if you're using a Raise portfolio, you should be doing at least minimum 3 years, 4 years, 5 years or more of investing. Long-term investing we're talking about. So the moderate portfolio is pretty much the base portfolio that I would expect someone to use if they're using an investment app or any type of investing. 50-50 shares, 50-50 cash and bonds. Great if you don't really particularly have a goal, you're maybe just using the roundups, you want definitely higher returns than bank accounts will give you, and you know that your portfolio is going to go up and down a little bit over time, but who cares? You've got an investment time frame of 3 or 4 years and you're happy to just ride it out. So the moderate portfolio is a great starting portfolio. Moderately aggressive has 70% shares, 30% cash and bonds. This, in financial planning, we actually call this a balanced portfolio. I know it's not 50-50, but it's more of a balanced portfolio. So it generally suits a lot of people as long as your time frame is 4 years, 5 years, something around that time, and you're willing to understand and accept that the shares will go up and down. Don't look at what's going to happen next week. Don't look at what's going to happen in 2 or 3 years. Your time frame is sort of around the 5 year mark, don't forget. 3 to 5 years. And then the aggressive portfolio, which, let's be honest, I think most people gravitate to the aggressive one because they think investing is about making money. Gonna go into the aggressive one. Only pick the aggressive portfolio, which has 90% shares and then 10% cash and bonds. Only pick that if your time frame is 5 years or more, preferably 7 years, 5 years or more. That's because this is the highest growth portfolio. It's got the most exposure to shares, which should mean your returns are going to be highest over the long term, but it means your long term is longer than someone that was perhaps in the moderate portfolio. It is 5 years minimum. I have had my portfolio. I did select the aggressive portfolio. Remember, my tolerance to risk is pretty good because I've seen it all before and I know markets recover over the long term. I'm not worried about short term. I've picked the aggressive, but my time frame is 5 years minimum. I've only had my account for 4 years, so I haven't even reached my time frame yet. I've still got another year to go. So really, who cares what my portfolio is doing right now? Just leave it to be. Now, Raise also has 2 other portfolios. They have one called the Emerald, which is ethical investing. It's for people that don't want to invest in tobacco companies, alcohol companies, firearms. They like sustainable energy ideas, more ethical sourced investing. That portfolio is for you. It does have 70% exposure to shares, so it is a minimum 3 to 5 year investment time frame. Regardless, just because it's ethical doesn't mean you've got less exposure to shares. And then there's the Sapphire portfolio, which is a relatively new one that Raise has. It has a small exposure to cryptocurrency, to Bitcoin. Now, it is coined the Bitcoin portfolio of Raise, but it actually only has 5% exposure to Bitcoin. It has 75% shares, 20% cash and fixed interest bonds, and then 5% exposure to Bitcoin. So that as well will show you the difference between crypto and share investing. Even Raise knows that crypto is speculative, it's higher risk, the highest risk. It only has 5% of its crypto portfolio actually in crypto. So take a little snippet from that about how the Raise investment managers are thinking. They're up for a little bit of Bitcoin exposure, but 5% of your portfolio. So that, to me, when you look at the share market portfolio exposure, 75% plus the Bitcoin, that's another 5%. They're all the growth assets there. That's 80% of your money is in shares and Bitcoin. So that is also, to me, quite a high risk portfolio. So you really 5-year minimum for that one. Raise is also now offering a custom portfolio where you can make your own. I'm not even really going to get into that because, quite frankly, if you're using a Raise investment app, it's because you want to get started with investing. It's because you want something done in the background of life. You don't want to be picking and selecting which ETFs you're doing and when to buy and when to hold. So it kind of like defeats the purpose, I think. If you've got a time frame of only 1 year for a short-term goal, use a high interest account or something like that. I don't think a Raise investment app or any investment is good for such a short-term goal. If you've got a time frame of 2 to 3 years, maybe you want to pick the moderate portfolio, 50-50 shares, 50-50 cash and fixed interest. If you've got a time frame of 3 to 5 years, you can ride out more of the share market. So maybe you want to go the moderately aggressive portfolio. And if you've got an investment time frame of 5 years or more, you're looking for the highest returns, you're not going to be concerned with short-term fluctuations, perhaps pick the aggressive one. Whatever you do, stick to it and you will get wealthier over time. So that's it for me today. If you like what you saw, please don't forget to subscribe. I don't want you to miss out on a thing when it comes to money matters. And share this video around to your friends and family. Let's get people talking about money and get financial fluency up. I will see you next time with another money video. In the meantime, if you've got any questions or something you want to hear about particularly, please drop a comment in the box below. See you later. Bye.